Hi everybody, welcome back to T.U.B Investing YouTube channel. So today I'm going to talk about what I stopped in my last video, right? How to invest or choose company in 2023, right? Where a time period where everybody's talking about recession, right? So this is a continuation of my last one of the three videos in my list. So one of these is my opinion of investing in 2023 and what I want to do. The second video is the most important video that you will need to watch in 2022, and the last one is my previous video, recession coming, now what should we do, right? So all these videos are in the links below. Please please watch them as well, and then to have a better understanding why I said all this today, right? So how do we choose the company, right? So my opinion of this company that I want is they can survive, endure the recession, or even gain market share during this recession, and strive when the bulls arrive, right? Strive to the moon, right? Like what everybody say. It's like the picture, right? This bull is going through, pushing through this red market, and then we should wait until the bull go through the red market, and then we will go to the moon. So that is the point here. You want to choose this company that can survive, endure recession, that could be more than 1 year, or even gain market share, and strive, rise in the share price when the bulls arrives again. So in my opinion, there are two types of company here. Type 1 of company is companies that obtain free cash flow excluding stock-based compensation. Type 2 of company is companies that do not have free cash flow excluding stock-based compensation, right? I talked about FCF x SBC in my last in the video that I stated that this is the most important video that you need to watch in 2022, right? So type 1 companies will actually be able to survive or endure recession easier. Type 2 will need a more thorough deep dive into the business model. However, on the other hand, type 2 companies will definitely have more potential to strive to the moon if selected properly, right? Because its share price has definitely been punished more in terms of during the last 2 years as compared to type 1 companies, right? So in the portfolio breakdown, you can break down between type 1 and type 2 companies from a 50-50 to a 10-90 perspective. It's up to your risk appetite. For myself, it's about 70-80% are type 1 companies. The other 20-30% is probably type 2 companies. But having said that, how am I selecting these companies, right? So there are 5 factors to consider. 1, free cash flow, excluding stock-based compensation valuation. So this means that what I want is the current share price will be undervalued to the free cash flow excluding stock-based compensation valuation by at least 25% buffer, right? So current sentiment, right? Meaning companies that I want to select, the current sentiment must not be good, right? Because when I did my research, right, companies that has a very good sentiment, that means it's in the green significantly, right, with companies that are probably oil and gas or value stocks, right? These are companies I have my opinion that is probably in some sort of bubble, and then I don't want the company right now that I choose, right, their current share price is near their 52 weeks high, right? So I want this company that their current share price should be less than 50% should be off 50% of their 52 weeks high, right? And then also current market valuation, PE, PEG, EV divided EBITDA. So these are something that I want to look at based on the current market situation. For example, if 1 or 2 is one is negative, right? But they do have earnings, right? This could PE, PEG, and EV over EBITDA could probably provide some sentiment about how market value this company. And the debt load itself, the debt to EBITDA, I want it to be below 3.5x. And then for the final point is that, I mean, there are companies that definitely feel 1, 2, 3, 4, right? But if you have a deep enough, right, you can understand its competitive edge and the competition around it, and how can it win, right, during this recession, and how can it probably gain more market share as well, right? So if a company has an edge, it could probably maintain its market share or gain more market share when everybody's hurting during this recession period. So for 1 to 4, I'm actually building a calculator with a scoring system that I will introduce in the future. But on 5 itself is something on your personal opinion. You will need to definitely understand their business model, do a deep dive on their fundamentals, rather than their fundamentals, do a deep dive on their business model, understand how they can gain more against their competition in this market. So let me maybe show how a type 1 company with free cash flow excluding stock-based compensation will help to navigate this situation, right? So for example, you will start with revenue growth. If a company has revenue growth, there's a higher potential that growth in free cash flow x stock-based compensation will be higher, and this could lead to multiple expansion in the valuation, right? And then with free cash flow, they can repay more debt. I mean, companies with already low debt to EBITDA ratio will reduce the need to constantly monitoring this kind of debt level, and if they can repay debt, right, this will leading to more cash eventually flowing into the balance sheet subsequently, right? So when more cash is flowing into balance sheet, you will have a strong balance sheet. You will strengthen the balance sheet and allow for more future growth. Probably if you have more cash, more future growth, more IMA, buying companies up when they are hurting, so all this will allow your company to grow even further in the future, right? And the company must have a moat and edge against competitor, right? And the most important, if it can continue to gain more market share, right, in this environment, this recession style of environment, then definitely when the bull arrives, it will have a higher opportunity to rise to the moon, right? So what happens if, like for type 2 company, there's not even a free cash flow it's not even free cash flow positive, right? I apologize, I was coughing just now again. My cough haven't fully recovered, so I apologies. Nevertheless, let's come back to this. Type 2 company, if they don't even have free cash flow, not profitable, what should we look out for, right? Firstly, they still need to have revenue growth, right? So revenue growth will eventually lead them on a path to obtain free cash flow, right? And management should always try to communicate this point that they are on this path of gaining free cash flow, right? So they should still have low debt to EBITDA, right? Or even if they have debt, this debt should be fixed or low interest rate debt. So you need to dive into that 10K to understand how is their debt price, right? And they should still have strong balance sheet in terms of current ratio, low debt multiples, right? So with a strong current balance sheet, right, they can withstand more than 1 year of recession probably, and you can. This will give you a better. This will keep you in have a better understanding of business. So you also will need to go through emotional, I would say roller coaster, right? If you understand, they always have this strong balance sheet to endure what's coming, right? Especially during recession. And finally, I just want to end off like companies should definitely. So this type of company must definitely have a moat on the edge against its competitor, right? So you need to deep dive into type 2 style companies. So in a summary, right, what I want to find a company that must be able to survive and endure during this long recession and should try to be fundamentally strong, undervalued as per its FCF x SBC valuation, right? But regardless, company must have an edge in this industry against its peers, and if able to, they must grow and gain market share, right? Eventually leading to multiple expansion in their ratios and reaching, so their share price will rise significantly when the bull arrives. So I'd like to end this video in this whole series, right, with this ending statement, right? It's easier by Robert Kiyosaki. It's easier to invest for cash flow during a financial crisis. So don't waste a good crisis by hiding your head in the sand, because the longer the crisis lasts, the richer some of them will become, right? And this is what I believe. Like I say, generation wealth, something that we should look at eventually. So I reached the end of this video. Please like this video so that I can share this message to more people, and subscribe to my channel for more interesting financial videos. I'll probably I'll probably go back to talk about small cap stock in the after this video. So do subscribe to me as well. Thank you very much, and Happy New Year.